welcome to our Jobkeeper payment, a practical guide for startups webinar. We're so glad that you could join us, and it is very timely indeed with the government announcing the new regulations and exceptions yesterday. Today we are joined by our chartered accountant in residence from William Buck, Alex Zinzopoulos, and Jack Chi. Jack Chi and Alex are chartered accountants and advisors to the technology sector, and they love helping founders succeed and have extensive experience growing startups and scale-ups all the way to exit. So today they'll run you through a short presentation. We've collated questions and they'll try to address this throughout their presentation, and please feel free to ask questions throughout. We will also check in at the end and have a quick Q&A for anything that isn't covered. I'll hand it over to Alex and Jack.
Thanks, Emily. All right, thanks everyone for joining us. And when we were organizing for this webinar, there was a bit of back and forth trying to figure out what's a good time to, to do this. And at that time, the alternative rules on the decline of, in revenue hasn't been released yet, and it was in anybody's guess, and in the end it turns out that the date we chose could have been more perfect. For today's webinar, we will go through a overview of the Jobkeeper payment subsidy. We'll also have a strong focus on the alternative test, because really this is what the major bit of news in the last 24 hours, and this is going to be extremely relevant to a large number of startups. Okay, so the overview of today, these are the main topics we're going to go through. We're going to talk about the broad principles. We're going to discuss what's an eligible employer. We're going to talk about the basic test, which was released a while ago in terms of measuring whether you've met the requisite decline in turnover to be eligible. And of course, then we're going to move on to the alternative test. And interestingly enough, there's actually 7 of them. Then we're going to move on to eligible employees. We're going to discuss the concept of business participant. We're going to talk about the administrative aspects of it. And there are a number of considerations on the admin aspect. And then we're going to talk about the tips and traps, because for something that is meant to be rolled out across the economy as a whole, this is surprisingly complex. There's a lot of things you could get caught up on, and a lot of the concepts are actually tax-heavy concepts. Hence, you're talking to accountants. Okay, so that's an overview. So let's talk about the basic principles. Okay, so next slide, please, Alex. Okay, thank you. So the Jobkeeper program is essentially the government's way of, keeping people employed, right, post COVID-19 world, and it is by far the biggest government measure in revenue terms. And it's available to employers and in select situations, sole traders. And the program runs from 30th of March to 27th of September. Now, you would know some of these basic things by now, but I'll just quickly go through them anyway. So the payment of $1,500 per fortnight per eligible employee, and it's paid by the ATO directly to the employer after the end of each calendar month, relating to fortnights ending that month. Okay? And there's various eligibility criteria and reporting requirements. Now, what's the eligible employer? The employer is, as of 1 March, the entity carry on business in Australia, and it either satisfies the decline in turnover basic test or the decline in turnover alternative test. The entity cannot be a bank, government agency, company in liquidation, or bankrupt individual. So I think, we're okay today. And the entity must pay the employee at least $1,500 per fortnight in salary and wages. Okay. Next slide, please.
Andrew's just asked a question. My daughter plays in a band and has lost income from not performing. Is she eligible? Andrew, this is exactly what this webinar is about today. So there's a bunch of conditions that need to be satisfied. So let's run through it. And then at the end, if you still need that question answered, happy to help.
Yeah, so we definitely allocated time for questions, and we will probably start answering those questions towards the end of the webinar, because some of these questions would be answered as we go through them. Okay, so we'll definitely set aside time for questions. No questions will be left out. So, okay, so let's move to the declining turnover test. So this is the basic test. So you would know by now that the government is trying to help businesses, employers that has been hit by COVID-19. So some people, if you're a surgical mask manufacturer, then the test isn't the payment isn't for you. So this is one of the key eligibility criteria, is that there's got to be a required decline in turnover. And the turnover definition is the GST turnover, and it compares 2 points in time. Now, those 2 points in time vary depending on the circumstances, depending on the employer in question, and there's a lot of complexities which we'll hopefully declutter for you today. But essentially, the 2 points in time are the turnover test period, okay, and what's known as a relevant comparison period. So the comparison period, just think of it as 2019, so pre-COVID-19, before the world changed forever. And then the turnover test period is sometime, post-COVID-19, okay? Now, in terms of how much turnover there needs to be a drop-off, I think, for the vast majority, if not everyone here, 30% is a relevant figure. Now, the figure is 15% drop in turnover if you're an ACNC registered charity. And it's if you happen to be part of a massive international group with a global combined turnover of more than 1 billion Australian dollars, then the bar is set higher at 50% drop in turnover. So look, for the purposes of this webinar, we're just going to assume it's 30%. Okay, so in measuring this drop in turnover, you do need to consider the turnover related entities. So if you have major shareholders sitting on your share register, maybe they need to be included as well. Okay, all right. So now the turnover test period. Now this is the think of this this as the post COVID-19 point in time. So recall that you need to compare 2 points in time, and this is the later point in time. So the turnover test period is any of the following. So any calendar month of March to September 2020, or the June 2020 quarter, or the September 2020 quarter. Okay, and you got to compare that, any one of those, with what's known as a comparison period. So let's just call it 2019 period. Okay, and so the entity has, so the employer has the choice which turnover period to compare. Okay, so you can use any of the month of March to September, or you can use the June quarter, or you could use the September quarter. Okay. Next slide. Now, some of you would recall that in your business activity statements, there's this concept of accruals basis or cash basis. Without needing to make everyone an accountant, as the name suggests, cash basis is when you recognize revenue as you receive the cash, whereas accruals is when you do the invoicing. Yeah. So if an entity reports GST on an accruals basis, they need to continue using the accruals basis in measuring, in comparing the 2 points in time. Okay. Now, whereas this compares with the entity reports GST on a cash basis, they can choose between using the cash basis or accruals. But whichever of the two methods they choose, that method needs to apply for both the before and after COVID-19 period. Okay, so you've got to be consistent. Now, the decline turnover needs to be calculated on a standalone entity basis. So some of you may be familiar with the concept of a GST consolidated group or tax consolidated group. some startups often have one business as part of a group structure, whereby a holding company holds shares in a trading company which employs employees, and another company holds the IP. That's a really good structure. Provides a lot of benefits, including asset protection. Now, that type of structure has not been really taken into account in any great detail by the Jobkeeper, because the Jobkeeper only looks at the employee entity. Okay, so and that throws up its own complexities. There are some modifications when calculating the decline in GST turnover. I don't think any of these are going to be really relevant to the Stone and Chalk cohort. Input tax sales, so this is more to do with financial institutions, interest, dividends. So that is excluded. Okay. Ignore sales of capital assets. I really can't picture startup, having massive sales in capital assets. And if they're part of a GST group, okay, only include the turnover of that standalone entity. Okay, and when calculating that, you don't ignore transactions with other members of the GST group. Okay, so it's very much focused on the employer.
Yeah, and just a couple of points to add to that. So GST-free revenue is still included. I can see a few questions of those coming through. So government grants, a lot of government grants seem to be GST-free. So if they are GST-free, you would continue to include those in your turnover. And any foreign income. So foreign income, I'm assuming, is maybe subscription revenue or sales to overseas customers. Those would also be GST free, so you would include those in your turnover. Okay. All right. Now, the basic test, look, it's great for certain types of taxpayers. For startups, it's not so good, because startups, by their generally nature, are pretty scalable, and they can generate revenue pretty quickly. So this was one of the areas that was addressed and was lobbied to the government. And because of that, the alternative test was introduced. And up until yesterday, we had no further information of the alternative test. So about midday yesterday, they released all these measures for, as Jack said, about 7 classes of entities that may qualify for the alternative test. And overall, we think these are going to address quite a lot of startups. Okay, now the 7 types of taxpayers or classes of entities that will be eligible or can apply the alternative test, you'll see they're listed on the screen. Entities not in business 12 months ago, entities that acquired part of their business or sold it, or restructured their business. Number 4 is the one that's going to be probably most relevant to a lot of startups, and that's entities that had a substantial increase in turnover. So let's say in the last 12 months, their business has really grown and expanded, and then 2019 was a good year, and then COVID came and revenue dropped. So this is the one that we'll spend a bit of time on. We got entities affected by natural disasters and bushfires and droughts. And number 6 is also relevant. So entities with irregular turnover. So that's going to capture a few entities that maybe you do upfront subscription fees or have lumpy revenue. You may be able to satisfy the decline in turnover test under number 6. And then sole traders and small partnerships. Now, I will just mention that because we have been getting a lot of this question over the last few days, what if my startup is pre-revenue? Unfortunately, it doesn't seem like at the moment that they will be eligible. Until such time the Commissioner releases, expands this list of 7 types of entities and includes an 8th one for pre-revenue companies, it doesn't seem like they'll be eligible. And the government's very well aware of that, and hopefully they will address it. Let's talk about things. So Jack mentioned earlier that what you're doing for your decline in turnover test is you want to assess your turnover from 2020, a period of time, to a certain period of time in 2019. Okay. Now, where the alternative test is going to be applicable is, well, what if that point in time in 2019 was not a true reflection of how much your business has been impacted by COVID? Okay, so what these alternative tests do, well, they'll say, okay, maybe we're not going to look, let's say you're comparing a test at April 2020, maybe April 2019 was not, is not a true reflection of your business and the revenue that you've lost. So what these alternative tests do is they'll substitute that 2019 period with another period that might be a bit more applicable. Okay, so the first types of class of entities that can say or apply under the alternative test are those that weren't in business 12 months ago. Okay, so if you recently incorporated a company in the last 12 months, or your company wasn't trading but it started trading in the last 12 months, then obviously you don't have a month or a quarter in 2019 to compare your decline in revenue to. So this is what this measure is specifically aiming at. Now, if your business was incorporated trading in the last 12 months, what you do is, instead of, you take the revenue or your GST turnover from the time you started trading, you do it till the end of February 2020, and you take the average of that. Okay? You take the average of that to find out what your monthly turnover was, and then you compare that to your current period. Okay? Does that make sense? So if you're trying to, if you want to compare your declining revenue for the month of April 2020, you find out what all the GST turnover was in the prior year since you started trading up until February 2020. You take the average of that so you can get your monthly turnover, and then compare that to your April 2020 turnover. That's how you assess the 30% decline in revenue. If you're using a quarterly test period, you take 300% of that to reflect 3 months. Now, that's that first alternative test. So this is a bit of a strange one, where we're in the first alternative test here for entities that haven't commenced business in the last 12 months. But there's two subsets of that. Okay, so that's the one that I just described is the first alternative test. Those businesses also they can rely under a second alternative test, provided they commence business before December 19. Okay, so if you're in that period of about March 2019 to the end of November 2019, instead of calculating your monthly turnover for that whole period of time that you commence trading, you can also just take the GST turnover of December 19, January and February, and take the average of that. Okay, that's if you're testing on a monthly basis. Quarterly, it's just the actual turnover of those 3 months.
So for the entities that did commence business before 1 December 19, they're able to cherry pick and pick one that's most suited for them.
Yeah. Okay. If any, with all these alternative tests, if any of your business have been affected by bushfires or natural disasters, you exclude those months. I don't know if there's any that are going to be relevant in that, but happy to take any Q&As towards the end of it. Okay, so this one here will be relevant to a few startups. The second is for entities that have acquired or disposed part of their business. So let's say 12 months ago you were trading and you had a few different service lines in operation, and then subsequently you sold part of your business, and there's a decline in turnover there, or maybe the opposite. I think the opposite is going to be more relevant. So maybe if you've acquired a business during a year and your revenue went up, but it's not a true reflection of what your current revenue is. So this second alternative test is to capture those types of entities. So if you've had any sort of change in your business structure, acquiring a business, disposing of a business, and last year's revenue is not representative of the decline in revenue you've experienced, what you would look at is the turnover of the month immediately after the restructure or the acquisition or the disposal. Okay, just so then you can get a more accurate reflection. And then that follows on to the third types of entities and business. So same thing. If you think about acquisitions, disposals or restructures, think about them together. In any month that you've had that, you look at the following month's turnover when you're comparing it to this year. Okay, now the next one here, entities with substantial increase in turnover. This is the one that we think is going to be the most relevant to startups. Okay, so what if you've been around for a couple of years, say 2018 revenue was okay, but then 2019 you took off, and then 2020 comes along and your revenue has has dropped, but it's not a true reflection. This is the one that will apply to startups. So what you can do, and I'll just reiterate the comment, is you can pick and choose which test you want to rely on. So if you satisfy the basic test, by all means, go for the basic test. If you satisfy basic and alternative, maybe choose the one that's less hurdles to jump through. But you don't have to satisfy all of them. It's just you pick one, and if you satisfy it, go for that. So if an entity had an increase in turnover, what you would look at is your 12 months before your test period. So if you want to assess a decline in turnover for the April 2020 period, okay, what you would do then is you can pick one of these three. So you could look at your turnover for the preceding 12 months. Okay, so March 2019 to March 2020. Look at March 2019 and then look at March 2020. If March's 2020 revenue is 50% more of March 2019, you could come under this alternative test. Okay, so just for the purposes of this, we're using April as a test period. If you're listing the month of May or the month of June 2020, you change these timeframes accordingly. Okay, but so April 2020, if you want to be in under the 50%, you look at March 2019 to March 2020. If you don't satisfy that one, you can also look at the previous 6 months. So what's that, about October or so? October 2019 to March 2020. And you compare October 2019. And then if revenue's gone up by at least 25% in March 2020, you could also fall under this boat. And the third one is 12.5% in the 3 months. So January, February, and March 2020. Okay, now this is the gateway to get into the alternative test. Okay, so if you satisfy one of those, you can look at the alternative test, but to calculate your decline in turnover, you use a different set of periods. This is the trickiest part. So if you satisfy that you've had that substantial increase in revenue, let's say March 2019 to March 2020 was at least 50% or more, then what you're comparing to, you compare the April 2020 period to the turnover of January, February, and March 2020. That's the confusing bit. So you take the average turnover of those 3 months. Even though we may have looked at March 2019 to March 2020, we look at the turnover of January, February, and March 2020. We take the average of that and then apply it to April 2020 turnover. Okay, and that's the same if you're relying on that 25% or more in the 6 months or the 12.5% in the 3 months. Regardless of which one you fall under in the first hurdle, your comparison period is always going to be the turnover of the 3 months before April 2020. Okay, I think that's the trickiest part of this alternative test, and we've seen a lot of questions come through for that.
Okay, so think of those, the top half of the screen we're sharing right now, think of that as the gateway. Okay, so if if you are able to go through the gateway, then you are able to use a different comparison period, which should be more advantageous. Okay, so that's, think of it that way, and in overall terms, and you should become less confusing, and then you can work out the details of exactly what that means.
And by droughts or natural disasters. Again, if you're in that boat, happy to answer it at the end. But the general gist of this is, if 2019 was a really bad year because of drought, don't look at 2019's revenue, look at 2018's revenue. Okay, now this is the sixth one, I believe. So entities with irregular turnover. This is also going to be relevant to a few startups, especially if you're kind of billing in advance. You may have subscription fees or licensing agreements that cover 1, 2, or 3 years, and it's payable up front. This alternative test is for entities that have irregular turnover. Okay, we're not looking at cyclical turnover. So if your turnover is irregular because of cyclical conditions or seasonal conditions, maybe to do with if you work in the snow or in holiday businesses, or maybe it's to do with crops and farming as well. It's not looking at that. It's looking more for lumpy turnover. Okay. Now, the gateway to get into this is have a look at your 12 months before April 2020. Okay, so again, March 2019 to March 2020. Split those into the quarters. So June 19, September 19, December 19, and March 20. Take the quarter with the highest turnover and take the quarter with the lowest turnover. If your quarter with the lowest turnover is no more than 50% of the quarter with the highest turnover, then you're in. Okay, so if in one quarter you build $100,000, if your lowest quarter was less than $50,000, so no more than $50,000, that's the gateway to get into this test. So it's really looking at those businesses where they've got lumpy revenue throughout the year. Now, similar to the first one about increase in turnover, that's the gateway to get in. How you measure it is you look at it slightly different. So you need to compare the monthly turnover of all those entire 12 months. Okay, so March 2019 to March 20, take the turnover of the whole 12 months, average it to get an average monthly turnover, and then you compare that to your April 2020 period to see if there's a decline in revenue. If you're testing on a quarterly basis, take 3 times that amount. So we think between the increase in turnover and the irregular turnover, these are ones probably going to be most relevant to startups. Now, the final one, the 7th one, is about sole traders and partnerships. If you're running your business as a sole trader or a small partnership that has no employees, and you've had a decline in turnover because you're a sole trader or one of the partners was absent, either through sickness, injury, or leave, what you do is you take the turnover of the month after that partner or sole trader returned to work. Okay, just to give a more accurate reflection of what the actual decline in turnover is. Okay, so that's the alternative test. That's a high-level overview of the alternative test. The rules were just released yesterday. There's also examples that they've released in the explanatory statement. I just want to emphasize that a lot of those examples are actually wrong and they don't tie back to the rules. So can I encourage you, please, if you are looking to rely on the alternative turnover test, that you do speak to us, get someone to actually review the forecast, because it is very detailed and there's things that just don't tie up at the moment. Okay, so if you've looked at the employer requirements, which is what we've done so far, So if your business has had that decline in turnover, either under the basic test or the alternative test, and it satisfies those other conditions we spoke about, well, next step is you need to know how many lots of the JobKeeper payments are you going to get. So it's $1,500 per fortnight per eligible employee. So what is an eligible employee? So an eligible employee is an employee of yours that was an employee as at the 1st of March 2020. Okay, if they're on the payroll at 1st of March 2020 and they're part-time or full-time. If they're a casual, there's an extra hurdle they need to jump through, and that is they need to be a long-term casual, which means they need to have been working with your business for at least 12 months. Now, the government is very well aware that there's going to be a lot of casuals that aren't working with their current employers for at least 12 months. And their response to this is they're not going to qualify for the JobKeeper, but they may seek the job seeker in their own respect. So employee, 16 years or older, and Australian resident or a New Zealand citizen under the 444 visa. They're not double dipping their JobKeeper. Okay, so they can only, employees, if they work for multiple employers, they can only claim the JobKeeper from one. And the employee cannot be a job seeker. So you know those lines that we saw outside of Centrelink for hours when people lost their jobs, so they can't be claiming one of those job seeker payments. And the employee can't be on paid parental leave, dad or partner pay, or on workers' comp. All right. Now, this may be relevant to some to some of you. There's this concept of business participant. Okay. Now, what if you don't have? What if you've got people working in the business and they're not actually technically employees? So you guys might be on this. Maybe you've got your own business, you're founders, and you're not drawing a wage. You haven't paid yourself a wage. So this is this concept of eligible business participant. It also applies to your sole traders and your other businesses structured as a partnership or a trust as well. So if you're not paying yourself a wage, so you're not on the payroll, you may be able to claim the $1,500 per fortnight for yourself. Be mindful though that it's limit of one per entity. So if there's two of you, if you're co-founders and you're both not paying yourselves a wage, you can only get the $1,500 total. It's not $1,500 each. What are the criteria for this one? The business needed to be in operation on 1st of March 2020. It needs to satisfy the decline in turnover test as what we just went through, so that hasn't changed. And again, it's not a bank, government agency, liquidated company, or bankrupt individual. And there's a couple of extra criteria that they need to meet, which is integrity measures. So it's to stop people kind of saying, oh yeah, we've run this business, and then they're going to add a bunch of people maybe to the payroll or seek to claim it other way. The entity needed to have an ABN on the 12th of March, and it needed to have turnover in the 2019 year and lodge the tax return with the commissioner, with the ATO, before the 12th of March. Or, so it's an either or test, or it's had income and it's disclosed the income in its BASs for July 2018 to 12th of March 2020. So if there's income in any of those BASs, and the BASs have been lodged with the ATO. Now, we've got the final point there is that the Commission has discretion to extend the due dates. So a lot of you, your 2019 tax returns wouldn't be due for lodgement until the 15th of May 2020. And maybe you're also reporting GST on an annual basis, not monthly or quarterly. The Commission is aware of this, and we're expecting that they'll extend this until those businesses actually lodge the tax return or the relevant BASs. So that's on the business. If you're the eligible business participant. What do you need to do to qualify for it, for the $1,500? It needs to satisfy the 1st of March 2020 requirements that we spoke about for employees. So 16 years or older, or Australian resident, or 444 visa. And again, not getting Jobkeeper, not getting Job Seeker, not on workers' comp. And the final point there is that it needs to be actively engaged in the business. We don't have any commentary as to what exactly means, but we would presume that if you're a founder, if you're listed as a shareholder and it's your company, it's probably fine to show that it's your business. It's more for the ones where if you've got, let's say you got maybe your kid, he's 16 years of older and he's doing a bit of work for you, or your partner is. What degree of work are they doing for the business? That's probably where it's a bit questionable. Okay, so that is the criteria, the eligibility criteria. Now, there's a lot to sink in. There's a lot of rules there. What do you need to do if you believe that you're eligible for it? Okay, this is the crucial part. We can talk about the theory all day, but the practical side of things as to how you actually apply for it and what you need to do to make sure you don't miss out on this. Because if you're eligible for the entire April to September period for Jobkeeper, for one employee, that's 20 grand. Okay, so this could be worth hundreds of thousands of dollars to a lot of businesses. Okay, if you haven't done so already, send all your employees a Jobkeeper employee nomination notice. This is vital. Even if you know they're not going to be eligible, you need to send all your employees the notice. What the notice says is it's the employee confirming with you whether they're an eligible employee. They confirm to you whether they're 16 years or older, they're an Australian resident or 444 visa holder, which you already know. But importantly, they need to sign a declaration saying that they're not claiming the Jobkeeper from anyone else. Send that out to them. They need to send that back to you and you file it away for your records. You also need to send your accountant the completed employee nominations notices so they can file it. Then if you want to apply for the Jobkeeper from the month of April, you need to enroll with the ATO by the 30th of April. And you need to do a second lot of enrollment by the 4th of May for payment. Okay, we're not at that stage yet. At the moment, it's the general enrollment. So make sure it's pretty straightforward. We've run through it ourselves. So there's not many things that you need to go through at this stage of the process. You just need to enroll, indicate how many employees you want to register for, and for what period you're testing. Commission is going to be paying the Jobkeeper within 14 days after each relevant period. So we're expecting, because we haven't got anything yet, there's going to be a catch up for the month of April, sometime in the first couple of weeks of May. And the employer must confirm the Jobkeeper eligibility each month with the ATO. Okay, so we haven't seen what that part of the reporting process is going to look like. We just know that every month the employer needs to do something with the ATO. Okay, now the next section here is tips and traps. This is a result of probably, I'd say, hundreds of questions our firm has received over the last week or so. We've kind of summarized them and they may answer some of your questions as well. The first one here, this was a big misconception when it first came out. You need to pay your employees first. You can't wait for the ATO to pay you the $1,500 and you pass it on to your employees. Now, this I think was a really big oversight on the government's part, because it pretty much means that businesses needed to fund a month or a month and a half of employee wages with potentially zero revenue. So that's an important one when you're considering your cash flow. Do you need to satisfy the decline in turnover test every single month? No. If you can show that you have satisfied it for the April period, you're in. You're in for the whole 6 months. If you satisfy it later, and this comes to the next point, is if you satisfy the test later, so if you're relying on May, July, August, you're not going to get the full 6 months worth of payments. So it's not 6 months from when you become eligible for JobKeeper. It's a maximum of 6 months from April to September. So how can you make sure you can get the benefit of the entire 6 months worth of JobKeeper payments? So we've listed there which are the relevant test periods. So March 2020 is actually a relevant test period. Even though the JobKeeper applies from April to September, you can look at March's turnover. So March 2020 is come and gone, you've got data for that already. If you can show that you satisfied it for the month of March, the month of April, or for the April to June quarter, that will get you in for the whole 6 months. So for the month of April and for the April to June quarter, obviously there's going to be historical figures and there's going to be forecasting. And that's perfectly fine. So use the data that you've got already for the month of March, 24 days, and then you can forecast for the next 6 days. Now, that leads on to the next point. As you can imagine, keep detailed records of how you're calculating forecast revenue. We very much think that the ATO is going to this information. If you're assessing that you've got a decline in revenue for the April to June quarter, make sure you've got robust or detailed calculations in place as to how you've calculated that. Now, the ATO has told businesses that if they have applied for the JobKeeper in good faith, and it turns out they don't actually have a 30% decline in turnover, let's say it's maybe 25, 26%, we don't think that's going to be a problem. But if you're telling the ATO that you're expecting a 30% decline in turnover and you've had no decline in turnover, or maybe 5 or 10% decline in turnover, you're probably going to have some explaining to do. Turnover is calculated on a standalone entity, not group basis. So again, if you're part of a group, you need to look at the turnover only of the entity where your employees are. We've been asked this quite a few times. Does my decline in turnover need to be as a result of COVID-19? No, it doesn't. A lot of businesses, by pure dumb luck, are going to be available for this measure. And that is perfectly fine. There's no integrity measures around that. There's no anti-avoidance measures. If you happen to fall into it, good on you. Payments and super. Okay, so if you're paying your employees, if they're on a wage of at least $1,500, now that's gross wage, gross before you've taken out any PAYG, doesn't include super. So gross wage of at least $1,500 per fortnight. You need to continue paying those employees their normal super. Super does not change. If you need to top up employees, so if your employee's normal wage is $1,000 per fortnight, so then you can get the JobKeeper for them, you need to pay them $1,500 a fortnight. That extra $500 top up, it's not subject to compulsory super. It's not ordinary times earnings. So what that means is you don't need to pay super for that $1,500, but you can choose to do so if you want. JobKeeper doesn't apply to contractors, but those contractors, if they're carrying on a business, might very well be able to apply for JobKeeper in their own respect. Payroll and Xero. Now, whatever payroll software you're using, there are a lot of payroll templates and categories that need to be set up for your employees. And most importantly, most of you are probably using Xero. For some reason, Xero has a cutoff of the 26th of April for your April employees, okay? So I just want to stress that. If you're relying on April as the test period, if your usual monthly payment date is the end of the month, those April employees, if you're doing it through Xero, are going to miss out. Xero has acknowledged this and they're not planning to fix it. So please process your payroll before the 26th of April. Okay. Now, that's the end of the formal part of our presentation. Jack, unless you've got anything to add, maybe we can jump onto the Q&As.
No, let's go straight to the questions now. I answered some of those, and you know, there's some remaining, and you know, we'll answer the best we can. And just know that, and there's the usual disclaimer of, you know, we'll answer the best we can, but you know,
yeah,
depending
okay,
on facts and circumstances. So it's not a tailored advice. Okay, so it's general commentary.
Okay, all right. So let's just go through the ones that are open there. So yeah, Andrew, going back to your original question at the start of the webinar, we hope that's answered it. As you can see, there's a lot of hurdles that the business and the employees need to jump through. But again, if it's more specific, feel free to reach out. Paul, I have an odd case where I stopped trading in my IT company 2 years ago. While I worked on R&D, learning new skills, you've been paying yourself a small wage during this time. Your turnover has dropped 30%, but the turnover is extremely low, non-existent for 2 years. Would I be able to apply? So if your business has been around for a few years, you can look at the basic test and your alternative test. Again, your declining turnover doesn't need to be a result of COVID-19. If you're satisfied because of the way that you've structured you've chosen to pursue other things and not billing clients, you may have, lucked into it. So assess the decline in turnover under the basic test or the alternative test. What if an employee moves from casual to perm? Okay, if the critical date is that 1st of March 2020, if they were a permanent employee, part-time or full-time as at the 1st of March, then they're in. If it was after that date, then you need to look at their casual status. If they're a long-term casual of at least 12 months, they're in. If they're not eligible.
Just jumping in here too, guys, please do send through any more questions you have. And if you don't have time to stick around today, these guys are open to running another session next week to help you with any other questions, as well as all the chartered accountants from Melbourne, Adelaide and Sydney. So just reach out if you don't have time or there is something you do want to ask after today.
Yeah, that's right. Thanks, Emily. And feel free to just reach out directly to our email addresses, which is including the slides that we're going to share, and actually it's shared on the screen now. Because we answer questions as part of our office hours.
Okay. Chloe, what if a staff member becomes eligible? I have a staff member likely to have her permanent residency approved next month. Does she get added to this initiative? Unfortunately, no. You look at that, the line in the sand is 1st of March 2020. And you test the employment status as at that date. If we are a family trust and the trustee is a company, would I get, sorry, my screen. Would I get the Jobkeeper as a business participant? Again, if you satisfy those 1st of March 2020 requirements, you're not on the payroll and you're actively engaged in the business. You work full-time somewhere else. Coles, can I still apply for the business participant for my business? No, so the Jobkeepers, it's a maximum of 1 per person. You can't apply for it as an employee and as a business participant. Armin, we registered, just had to check a box for 20% decline. How is the actual verification of these tests done? We believe that businesses will have to supply data to the ATO on a monthly basis. How do you apply for the alternative test? We believe it's going to be the same process as the basic test. You just do it through your business portal or through your accountant's tax agent portal. Andrew, follow-up question on the band. If the band as a partnership has lost income, how do they apply? There are 4 individuals, but they wouldn't have earned $1,500 a fortnight. If they're not employees of the partnership, it's the business participant. But again, it's only a maximum of 1 per entity.
Just jumping up as well again, there's another one just on the alternative test with the Commissioner. Just wanted to double check, there was another question about the forms. Do they have to wait for all answers to come back before they apply for Jobkeeper regarding trusts and other bits and pieces? Or is it better that they kind of just go with the new alternative tests and apply regardless of any grey area they may be?
Obviously have a look at the rules of the alternative test. If you believe that you're eligible for it and you can forecast a decline in revenue, then you can apply for it, and you just have to justify how you've done it. There is a time pressure on all this. Like I mentioned, there is the 26th of April for the payroll employees on zero, and there's a 30th of April date for enrollment. So this is kind of, we're all learning on the go here, but the ATO has been updating their forms kind of every day. So hop on when you register. If there's something that's missing, it will probably be addressed in the next 24 hours. That's what we've seen over the last week. I don't know if I'm doing these out of order or not, but do you know of any plans to include temporary visa holders? At this stage, no, it's limited to your Australian residents and your 444 visa holders for New Zealand citizens. If I have a permanent part-time job that I'm not claiming Jobkeeper with, but I have a startup that is eligible, can I claim? So each person can only claim 1 Jobkeeper. So I suppose so. You can pick and choose which one you want to do it for. Of course, you need to satisfy the relevant criteria, but there's nothing that says you need to do it with 1 employer over the other or 1 employer in the startup.
And I believe
you just need to complete that form and send it back to your employer, notifying them if you're claiming Jobkeeper with them or if you're not.
And that was some of the logic, it seems, behind this whole scheme, that there are a lot of people on part-time wages and you will only likely get approved for 1. So just make sure you can get through what you can.
And if you apply for all of them, there are clawback provisions, guys. So the ATO will have records of all this, and employees are actually jointly liable with employers. So if you falsely claim it, the employer can ask for that money back from you. Caroline, can I confirm that if the turnover declines by 30% in the forecast July to September 2020 quarter, can I start claiming Jobkeeper from April or from July? You miss out on April. So you actually miss out on April, May, and June. So to get the Jobkeeper for the entire 6 months, you need to do the declining revenue test for the month of March, the month of April, or the quarter of April to June. If you're doing any other periods, you're not going to get it for the whole 6 months. If one of the, Chloe, if one of the 2 directors is on payroll and the other one is not, does that mean that both can be eligible? Yep, one is an employee, one is a business participant. Juliana, at this stage, all we can do is enroll, get employees nomination form and submitting the payroll through STP. Is there anything else to do prior to 30 April? Let's see, employee nomination forms. You've paid your employees, I'm guessing, and submitted it through STP. Nothing else you need to do before 30th of April, except if you're on zero, you need to do it by the 26th. The Coles is not eligible for Jobkeeper. Would I get the business participant for my company as I am a director? No wage. So yeah, you can pick and choose which one you want to claim it for. Okay, so if Coles is not eligible for the Jobkeeper, probably because they haven't had a decline in turnover with everyone buying toilet paper and hand sanitizer, then you can do it for your own business. If you're an employee, you do it as an employee nomination form. If you're not on the payroll, you can do it as a business participant. Yeah, what he said, director, no wage. So yeah, as long as you satisfy the other criteria. And my another question, in the JobKeeper nomination notice, your eligible business participation form from the ATO, it says you must also specify that you are not employed by another employee other than a casual. So I work full-time at Coles. Can I claim for my startup business as a business participant? Yeah, we don't think that's going to be an issue. It's a person can claim one JobKeeper, maximum one per individual. Okay, if they're not getting a JobKeeper from somewhere else, they can apply for it in their own business or from another employer. Anonymous attendee, does his or her to be disclosed? Alex, does the income received through the programs affect my future tax returns? Is it taxable income? Yes, it is. Okay, because if your employee wages are deductible, then what you're getting is assessable. Not to be confused with the cash flow boost. I know we haven't talked about the cash flow boost today, but if you're getting the cash flow boost from because you've had employees, that's not taxable, but your JobKeeper is. And Danny, if I have a permanent part-time job that I'm not claiming JobKeeper with, but I have a startup that is eligible, yeah, I think I answered that already. Yep.
Yep.
You can pick and choose which one to claim before.
Any others, guys? Still got a tiny bit of time. But I think it's been a pretty thorough coverage. Thank you so much, Alex and Jack. It's been absolutely great, and I'm sure there will be more questions and more information still to come. So please do reach out, guys. We can organise those workshops and tailored sessions, and Alex and Jack are always available, as they mentioned. Also, if you do have time this afternoon, we have our third episode of Stone and Chalk Live at 4:30, a quick little segment. We have a really great panel with Tom Olhorn from TinyCX, Melissa Widner from NAB Ventures, the Managing Director, Chloe from Syrise Accelerator, as well as John McGiffin from Deep Recognition, a great AI platform. And for tuning in, you can also get some drinks, a slab of Moondog beer delivered to your door. So be sure to join to be in the running for that. Also, after this, there will be, we've got one more question come through, but after this, we do have a quick survey, and it would be really great if you could just answer that so that we do know how it went and if we can make it better for you next time. We'll get to these last few questions.
Are there any tips on Reckon software or links for JobKeeper? I believe there are. I know Xero has and MyOb has, so I don't think Reckon would want to fall behind their competitors. So go onto their help and see if there's any specific tips for Reckon. Caroline, not sure I got an answer for the employee part-time and also a job seeker allowance top-up is paid. Can they also claim JobKeeper as a payment of $1,500 per fortnight? Would mean they're no longer getting any job seeker payment. Yeah. So each individual, it's either job seeker or JobKeeper. They've got to choose. Okay. And that's something that the employee needs to tell you as well as part of the nomination form. They can't get both.
Excellent.
Thanks, Paul.
Yep. Great. I think.
Another one from for the full time, the director has a wage, but not every month. They just need to, if they've been paid a wage before, have been paid 7 out of the 12 months as wage based out of performance of business. If they've been paid a wage before the 1st of March 2020, that means they're on the payroll, which means they would be a permanent employee. What's their employment contract look like? I would say just have a look at that and maybe put one in place. But if they have been paid a wage, then technically they are an employee and they can satisfy that 1st of March 2020 requirement as an employee. Now, If they qualify as an employee, you need to continue paying them as an employee, that $1,500 per fortnight. If they're not an employee, if they're a business participant, actually this is one thing I forgot to mention. If you're getting the $1,500 per fortnight for a business participant, that business participant, you don't need to put them on the payroll. So you can leave them as a non-employee, and there's also no requirement to actually pay them the $1,500. So if it's an employee, you get the $1,500, you pay it to the employee. Sorry, let me rephrase that. If they're an employee, you pay the employee, you get the $1,500 from the government. If they're a business participant, you get the $1,500 Jobkeeper, and then you can do with it as you wish, as you please for a business. Don't need to pay it to the business participant, and no need to put them on the payroll.
Perfect. Thank you so much, Alex and Jack again. I think we might tie it up there. Please do send through any other questions you have to these guys after this.